Hey everyone, welcome back to Stock Predictor. Today we're diving into something that has completely caught investors off guard. I'm talking about a dividend ETF that is paying big, much bigger than anyone expected, and the shockwaves are spreading across the entire income investing community. If you're looking for a reliable stream of passive income, or even trying to build a portfolio that can handle inflation and market volatility, this is the video you'll want to watch until the end, because this ETF may change the way you think about dividend investing in 2025. Before we jump in, make sure you hit that like button, subscribe if you haven't already, and turn on notifications so you never miss updates on the top stocks and ETFs shaping the markets right now. Alright, let's get into it. So here's the deal. When people think about dividend ETFs, they usually expect stability, modest returns, and a predictable but not too exciting payout. But what if I told you that one ETF has completely broken that mold? What if I told you that while everyone was focusing on tech stocks, crypto hype, and short-term trading strategies, this quiet income ETF was quietly generating a massive payout that almost no one saw coming? Investors who were paying close attention have already noticed. But for most people, this came out of nowhere. The ETF is delivering one of the strongest dividend yields in the market right now, and the fundamentals behind why this happened are even more interesting than the payout itself. Because once you understand why these distributions are growing, you'll also understand whether the big yields are sustainable, or if this is just a temporary spike that could fade as quickly as it appeared. Now, the ETF I'm talking about has recently grown its distribution rate far faster than expected. Part of the reason no one saw this jump coming is because the broader market has been incredibly unpredictable. Interest rates have been hovering at multi-decade highs, inflation has been sticky, and investors have been unsure whether the Federal Reserve is ready to cut rates or keep them elevated longer. Whenever interest rates get this high, dividend ETFs suddenly become far more competitive, because investors can earn strong yields without having to take on risky speculation. But what really pushed this ETF ahead wasn't just macroeconomic pressure. It was the structure of the fund itself. While most dividend ETFs follow a strict, rules-based index, this one has the flexibility to rotate into sectors that are most likely to outperform during periods of uncertainty. It's not locked into the traditional dividend-heavy sectors like utilities or consumer staples. Instead, it can move into financials when rates rise, into energy when global demand increases, and into industrials when government spending ramps up. That flexibility is exactly why this latest dividend spike took investors by surprise. Most people assumed dividend growth would stall because companies everywhere were tightening their expenses. But inside this ETF, many of the holdings were actually benefiting from the economic environment. Companies in energy were generating strong cash flows, banks were receiving higher net interest income, and several industrial firms saw major boosts from infrastructure and manufacturing investments. All of this combined to create a perfect storm for a higher than normal distribution, and it showed up as soon as the ETF announced its latest payout. Of course, a huge dividend payout always raises questions. Is the yield sustainable? Is this a trap where high income only appears temporarily while the share price declines in the background? Or is this the kind of ETF that actually rewards long-term investors with an increasing income stream? Year after year, to answer that, we need to look deeper into why the dividend increased. One major reason is that the ETF's underlying companies are producing strong free cash flow. Free cash flow is the engine behind every healthy dividend. When a company generates more cash than it needs for operations and investments, it can return that money to shareholders. And right now, several sectors inside the ETF are producing record-level free cash flow. Take energy, for example. Even with oil prices bouncing around, many of the large energy companies have been reporting much higher margins than expected. Higher margins mean more profits. More profits mean more cash flow. And more cash flow means bigger dividends. The ETF holds multiple large-cap energy stocks that have either increased dividends or issued special dividends. Those special dividends flow into the ETF's distribution and inflate the payout. Then we have the financial sector. High interest rates hurt borrowers, but they actually help many banks and financial institutions. When the spread between what banks pay depositors and what they earn on loans increases, banks make more money. That boost in profits leads to higher dividends, which again increases the payout for the ETF. Now, here's where it gets even more interesting. The ETF doesn't just rely on high-yield stocks. It also includes companies with strong dividend growth track records. This is crucial because even if yield temporarily dips, dividend growth stocks ensure that the long-term income stream keeps rising. Think of companies that have increased dividends for 10, 20, even 30 consecutive years. When you combine high-yield companies with consistently growing dividend payers, you end up with a powerful blend of income stability and income growth. This combination is exactly what makes the ETF stand out from the rest. Investors want steady income, but they also want growth. They want protection from inflation without sacrificing returns. And that balance has allowed this ETF to surprise the market with a total payout that would normally take years to develop. But let's talk about sustainability. A high dividend today is nice, but investors want to know whether they can depend on it. And based on the ETF's structure, its holdings, and current economic conditions, the yield looks more sustainable than many people think. The sectors driving the increased payout are not experiencing short-term bubbles. They are experiencing fundamental growth driven by long-term economic shifts. Energy continues to benefit from global demand that has remained higher than expected. Industrial companies are benefiting from large-scale infrastructure investments. Financial institutions continue to earn higher interest income. And technology companies that produce strong free cash flow continue to balance the ETF with long-term growth potential. Investors often worry that high dividend yields signal danger. Sometimes, they're right, a yield can look attractive because the stock price has dropped significantly. But in this case, the ETF's price has remained stable, which means the yield isn't inflated by a falling price. It's driven by genuine increases in dividend distributions. Another big advantage of this ETF is diversification. A single dividend stock can cut its payout without warning. But an ETF, especially one with dozens or even hundreds of holdings, spreads that risk out. Even if one company reduces its dividend, the overall distribution can remain strong if the others continue performing well. This is especially important in today's uncertain markets. Now, let's talk about why so many investors didn't see this coming. The truth is, most people focus heavily on growth stocks. They chase the next big tech company or the next high-flying AI play. Meanwhile, income ETFs operate in the background, quietly compounding wealth for long-term investors. Because they don't produce dramatic price swings, they don't get the same attention. But this ETF has shown that steady, income-focused investing can deliver surprises too, big ones. And this is exactly why dividend ETFs deserve more attention in today's market. In a world where interest rates may stay elevated longer than expected, income-focused investments become more valuable. Investors looking to retire, or simply looking for passive income, are starting to shift from high-risk assets to reliable cash-flowing funds. And as more money flows into dividend ETFs, yields may become even more attractive. So what does this mean for you? It means that if you're building a portfolio designed for long-term financial freedom, one that pays you month after month, year after year, you should at least take a closer look at dividend ETFs. Not just for the income they provide today, but for the stability they provide during market downturns. And this particular ETF, the one surprising everyone with its big payout, has shown that income investing still has room for growth. Now, let me be clear. I'm not telling you to buy anything. I'm sharing information so you can make better decisions. Always do your own research and make sure any investment fits your goals, risk tolerance, and time horizon. But if you've been sitting on the sidelines, waiting for a sign that dividend investing still has power, well, this might just be the sign you were waiting for. As we wrap up, let me say this: the market is full of surprises. Sometimes the biggest opportunities come from the places no one is watching. While the world is distracted by the next big tech stock or AI craze, income investors are quietly collecting checks from companies generating real cash flow. And this ETF is proving that steady income investing can still shock the market in a big way. If you want more videos breaking down top dividend ETFs, monthly income strategies, or stocks that could help you build real long-term wealth, make sure to hit that subscribe button, smash the like button, and share this video with someone who might appreciate it. Thanks for watching Stock Predictor. I'll see you in the next video.